Two people wake up at the same time tomorrow morning. Same age, same city, same degree, both making around $60,000 a year at their day jobs. But there is an invisible wall between them, and most people never even notice it's there. Person A wakes up to a loud alarm. The first thing they think about is their inbox. The second thing is the rent check due on the first of the month. Every dollar they earn today will require 8 hours of their physical presence, their mental energy, and their focus. If they don't show up, the money stops. Simple as that. Now look at person B. They wake up at the same time, but before they've even brushed their teeth, before they've even opened a laptop, they've already earned $47. It didn't come from a side hustle. They didn't grind for it this morning. It came from assets that kept running while they slept. The difference between these two people isn't luck. It's a single decision. The decision to stop only doing things that earn and start building things that earn. That's what this video is about. 5 specific assets, how they actually work, and why even starting small changes the entire game. If you're finding this useful, this is exactly the kind of thing I cover every week on this channel. Subscribe so you don't miss the next one. Let's get into it. Here's how to think about it. When you buy a dividend stock, you're literally becoming a part owner of a giant profitable machine. Think Coca-Cola, Johnson & Johnson, or 100 other companies like them. And because you're an owner, they send you a check every few months just for holding shares. That payment is called a dividend. A lot of people hear 3% yield and roll their eyes. They think, if I invest $100, I get $3 back. Why bother? Here's why you bother. In the beginning, dividend investing is painfully slow. It genuinely feels like watching paint dry. But then the snowball effect kicks in. When you take that $3 and reinvest it to buy more shares, those new shares start paying dividends too. Your money starts having babies. Then the babies have babies. The whole thing quietly compounds in the background without you doing a single thing. And here's something most people don't think about. Inflation is a silent thief. Cash sitting in a drawer loses value every year. But many dividend companies have a habit of raising their payouts annually just to keep up with rising costs. So you're not just earning. You're building something that grows and keeps pace with the world around it. The key mindset shift with dividends is patience. This is boring investing. And in finance, boring is usually a compliment. We all know the dream. Own a rental property, collect a check every month, retire early. But let's be honest about what physical real estate actually looks like in practice. Pipes burst at 2 in the morning. Tenants stop paying. Repairs show up when you least expect them. For most people, being a landlord isn't passive income. It's just a second high-stress job with worse hours. If you want the income without the plumbing calls, you need to know about REITs. Real estate investment trusts. Think of a REIT like a mutual fund, but for property. These companies own massive apartment complexes, data centers, shopping malls, warehouse facilities. And by law, they're required to distribute at least 90% of their taxable income back to shareholders, which means you get a cut of the rent without ever speaking to a single tenant. The comparison is pretty stark. A physical rental property might require a $50,000 down payment, a mortgage, and the joy of fixing someone else's toilet at midnight. A REIT requires $50, bought directly through your brokerage app, managed by professionals who actually know what they're doing. It's the lazy landlord strategy. You own a piece of the mall. You just don't have to sweep the floors. Now, before we get to asset 3, I need to tell you something your bank won't. Most people build these assets in the wrong buckets. If you earn $1,000 in dividends inside a regular brokerage account, the government could take $150 to $200 of that in taxes. You're working to build a machine. But the machine has a leak. Wherever possible, look into tax-advantaged accounts, like a Roth IRA if you're in the United States, or an ISA if you're in the United Kingdom. Think of these as armor for your assets. Inside these accounts, your dividends can often grow and compound without the government taking a cut every single year. It's not just about how much you make, it's about how much you actually keep. The third asset is the one everyone ignores because it sounds too simple: the high-yield savings account. Most people keep their emergency fund, their rent money, their just sitting there cash in a big-name bank account, earning around 0.01% interest. On $5,000, that's about 50 cents a year. 50 cents. You are essentially gifting your bank free money so they can invest it and profit from it. Right now, online high-yield savings accounts are offering something in the range of 4 to 5%. Moving your money takes about 20 minutes. On that same $5,000, you'd be making $250 a year instead of 50 cents. You didn't do anything different. You just stopped leaving money on the table. It's not going to retire you, but it changes your psychology in a quiet, important way. Your money is no longer just sitting there, doing nothing. It's a small, tireless employee working around the clock to cover your subscriptions, your utility bill, your streaming services. Dead money becomes alive money, and that shift in how you see it matters more than the dollar amount at first. The fourth asset is my favorite because it requires time, not money. Digital products. If you create something once that can be sold 1,000 times, you've created a ghost worker, something that earns for you long after you've moved on to other things. This could be a PDF guide on a skill you've spent years developing, a budget spreadsheet that solves a specific problem, a Notion template, a Canva design pack, a short ebook, a set of prompts. These aren't businesses that need your daily presence. Once the thing exists and people can find it, it can generate income indefinitely. I know what you're thinking. I'm not an expert. I don't have anything worth selling. But here's the thing. You don't need to be the world's foremost authority on something. You just need to be 2 steps ahead of the person behind you. If you spent 3 weeks building a budget template that actually works for your life and you put it online for $15 and just 10 people a month buy it, that's $150 every month from work you did once. Most people dismiss themselves too quickly here. It's not that they don't have anything valuable, it's that they've never thought about packaging what they already know. The fifth asset is the heavy hitter, index funds and ETFs. If there is one thing that has genuinely leveled the playing field for everyday investors over the last few decades, it's the index fund. The idea is simple. Instead of trying to pick winning stocks and outsmart the market, or which most professional fund managers can't even do consistently, you just own a tiny piece of everything. A broad market index fund gives you exposure to hundreds, sometimes thousands, of companies at once with almost no fees. Warren Buffett has recommended this approach for the vast majority of everyday investors for years. Not because it's exciting, because the math over time is almost unreasonably powerful. The secret here isn't timing the market, it's time in the market. Set up an automatic contribution, $50 a week, $100 a month, whatever you can genuinely spare. If the money moves from your paycheck before you see it, you won't miss it. And every share you buy today is quietly working toward a day in the future when you won't have to. Here's the thing nobody tells you when you first start building passive income. It doesn't feel like anything for a long time. You'll watch your dividend income hit $12 in a month when your rent is $1,500, and the gap will feel almost comical. You'll wonder if any of this is actually worth it. And that's usually where most people quietly give up. But something shifts when that first $12 hits your account and you realize, for the first time, that you didn't trade a single hour of your life for it. It didn't cost you a morning. It didn't require you to be anywhere. It just arrived. That feeling doesn't stay small, because it isn't really about the $12. It's the proof that the system works. And once you know the system works, you stop making fear-based decisions. You don't stay at a job that's draining you because you're terrified of the first of the month. You negotiate a little harder. You say no to things that aren't worth your time, not because you're wealthy, but because you have a margin of freedom that didn't exist before. That margin is what this is really about. So what does this look like if you're starting from zero? Month 1. Move your savings to a high-yield account. This takes 20 minutes and costs you nothing. It's the most frictionless first win available to almost anyone. Month 2. Set up a $25 automatic contribution into a total market index fund. The amount doesn't matter yet. The habit does. You're building the infrastructure. Month 3. Look at your skills honestly. Is there one thing you know, one problem you've solved, one system you've built for yourself that could be packaged and sold as a digital download for $10 or $15? You don't have to build an empire. You just have to ask the question. From there, you build. Slowly, boringly, without drama. I want to leave you with something honest. This is slow. There will be months where your passive income feels embarrassingly small. The gap between where you are and where you want to be will feel wide, and the temptation will be to assume it isn't working. But there's a compounding that happens in your confidence too. Not just your portfolio. The longer you stay with it, the less money anxiety controls your decisions. The more you understand how these systems work, the less powerless you feel inside of them. And slowly, not dramatically, not all at once, the number starts to matter in a real way. You don't need a finance degree. You don't need a windfall. You don't need perfect timing. You just need to decide to be person B. Pick one asset, just one. Start small, but start. Progress doesn't have to be loud to be real. Even one quiet stream of income that asks nothing of your time. That changes something, not just in your bank account, in how you carry yourself through the month. And that's worth building toward. Let's follow along and grow together.